And unexpected bad news for inflation. Wholesale prices accelerated in June to their highest rate since March 2023. So an indicator of where consumer inflation may be headed, the Producer Price Index, or PPI, rose to 2.6% for the 12 months ending in June. And the increase was driven by a sizable 0.6% rise in services, led by higher profit margins for machinery and auto wholesalers. Now, gasoline prices tumbled nearly 6% at the wholesale level. Food prices also dropping. Now, earlier I discussed the PPI report with the Chief Strategist at Mill Street Research, Sam Burns. Take a look. So, Sam, we got some not so welcome news today on the PPI number. Just to start off, is this a sign of inflation pressures building in the pipeline?
I think today's report was kind of a mixed bag. There were definitely, a higher number on the headline and the core rate than people were looking for. But when you exclude trade, it was actually, zero. It was flat for the month. So I think there was some noise in the data. And I think the overall picture is not one of accelerating inflation. It's just kind of some back and forth in the month-to-month readings. And so coming after the CPI, I think that there was a relatively, benign number in terms of the market reaction, at least so far.
So, I mean, we do agree that there's a noticeable difference between today's inflation report and yesterday's inflation report. So how do you interpret the discrepancy between the CPI and the PPI today?
I think, part of it just comes down to that they measured different things. And there had been some previous months where the CPI was a little higher and the PPI was actually weaker. And so I think you see this happen sometimes where they kind of flip back and forth. And in a particular month, one will be strong and one will be a little weaker. But if you look at the year-over-year growth rates of inflation rates in both, they're both generally trending down or at least stable. So I think once you kind of take out some of that short-term noise, you get a picture of inflation that's stable or improving. And that's really what the markets and the Fed are looking for, is signs that things are moving in the right direction. And that those data, the CPI and the PPI, are used to calculate the PCE, the personal consumption expenditure data, that will come out in 2 weeks from today. That will be the most important one for the Fed. That's the number they really look at. And those expectations are actually fairly modest now, looking for 0.2% or something like that for this month. So overall, I think the inflation data is still reasonably good and probably fits the description of improvement in the data that the Fed has been looking for.
Okay, so speaking of which, how close are we, do you think, now to the Fed officials having that confidence that they've been talking about?
So I think they're going to start to lay the groundwork now for a rate cut, and probably September is what it's looking like. So in this July meeting they'll have coming up, I think they'll probably start to talk more about how inflation has made progress, and the unemployment rate has ticked up a little bit. The labor market is not so strong, and therefore they'll be more comfortable with a rate cut sometime soon or something like that, and that will probably set up a September rate cut, and then maybe another one again in December. So I think that's probably the path they're going to try to start talking about now that we've seen the CPI and PPI data.
Is the Fed thinking that if they cut too late, because there is a delay with all this, that the labor market may suffer too much than needed?
Yeah, that's really the risk that they're balancing now, is that if they wait too long, keep rates too high, then they'll make the mistake like they have in the past. And once the economy really starts to weaken, and really you see the job market really start to kind of deteriorate and unemployment go up, then it's kind of too late. The interest rates won't affect anything for months, and after that, and you're already potentially risking a big slowdown or a recession before any rate cuts would really help. So they always have to battle that kind of long lag between a rate cut or a rate hike and the effect on the economy, and the fact that there are a lot of other things driving the economy outside of interest rates that they have no control over at all. And so they're trying to work within all of that. So I think that's the thing they're trying to balance out right now. But my guess is that, yeah, they'll probably want to go ahead and do something in the fall.
Well, all right. Thank you for your time today, this Friday, Sam.
My pleasure. Thanks for having me on.